So welcome everyone. Welcome to this webinar called Market Thursday. This week I'm good with the time and the date. So we are September the 24th and I'm here in London. So quickly, as always, I will be covering my background. So my background, I started in 2000 as a cash equity trader in Paris, trading first French stocks, then trading European stocks, then trading European stocks and US stocks. Then in 2004, I joined a hedge fund here in London, first on the long-only product, then as a long-short product. This hedge fund was called Griffin Capital. Then from 2009 to 2018, I was a prop trader at Infinity Capital Markets, where I had an absolute return mandate with no asset and returns constraints. In 2014, I started to do some mentoring for another company. Then from 2018, on top of managing my own money, I started to do my own mentoring program. And in October of last year, I launched the 4x4 video series. So that was from my background. Today, we're going to have many charts, many data. And we're going to be covering, as always, we're going to be starting with the situation across asset classes. Then we're going to be looking a bit of macro with the flash PMIs. We're going to be doing kind of special situation active trading with the end of the quarter rebalancing. We're going to be looking at oil and silver because I know that some of you are looking at it. And some of my mentees have exposure in the space. Then we're going to be ending with a Q&A session as always. So this week and since the start of the month, the equity market, the S&P is roughly down 10%. It's closing flat on the day almost. The Nasdaq composite is down 12%. So what, again, we're going to try to be doing today together is looking at the price action across asset classes. We're going to try to look at the next catalysts. Then we're going to be getting the big picture, the special situation and active trading with the end of quarter. And we're going to be looking at one asset. So that is really what we do when we do the mentoring sessions and what the subscribers of the 4x4 video series get when they subscribe to the product. So let me start with these asset classes performances, where on the left-hand side, we get the year-to-date, starting with indexes. Then on the right-hand side, we get the week-to-date. In the next slide, we're going to be looking even more into the week-to-date. So again, the equity market, you know, has been selling off. So no news here. And we can see if we go immediately into the next slide, into the next slide, that all major indexes were down on the week, 4% for the S&P. Actually, the Nasdaq composite has been outperforming a bit the S&P 500. The small and mid cap with the Russell 2000 have been suffering, down almost 7%. Europe has been pretty weak. Japan has been doing okay with the Nikkei down only 1%. And the rest of the world as well has been really struggling. If we look at the second asset classes that we have here, which is currencies, we can notice that the dollar has been pretty strong against almost any currencies. So there has been, after the sell-off maybe is a big word, but after the recent weakening of the dollar, there has been some reversion to the mean, at least over the last week, which has effect and repercussion across asset classes. So that's something that we're going to be covering today. One of the biggest drivers over the last week has been the strengthening of the US dollar. So hand in hand with that story, we've seen the gold weakening by 4%. If we look at gold on steroids, which is silver has been even more struggling today and the last week or so. And WTI is down 3% on the week, but trading around the $40. So if we carry on and look at the year-to-date sector performances that we do, we can see that the energy is off the chart. And we know that IT has been doing well. But more interestingly, on the week-to-date, since we last spoke last Thursday, energy has been really, really weak. So energy is always very weak. So that's a bit of, a broken record here, with energy being down 12%. If you look at technology actually has been doing pretty fine, only down 3%. The financials have been struggling. And more interestingly, something that we mentioned last week, XLK and XLI, which were doing okay at the start of the month, have been really struggling. So when you have XLI, when you have XLK struggling, you don't need to be a genius to know that there is fear on US growth. And this is what is happening across the world, that there are fear that the world is slowing again, or maybe going back into recession because of COVID. So we have inside this, this move over the week, actually strong moves across sectors. And that means alpha generation these days, and as always, could be and is working. If we look now into the bonds, the bonds have been pretty muted. So here, this is for the bonds, and I look at the year-to-date and the week-to-date. I mean, if you look at the US 10 years, it's trading between 50 bips and 70 bips, but actually these days it's trading between 60 bips and 70 bips. So nothing is happening. It's completely dead. So on one hand, you can argue that it's doing its job of safe haven. On the other hand, it feels like, it's this is exactly what the Fed wants to do, is putting everything under a massive shield. But really, it is not moving. The VIX has been spiking a bit. And here, I want to mention that something that is extremely important, and we covered last week, is we had last Friday the expiry. And if you remember correctly, we discussed the idea that after the expiry, very often there is some repositioning in the market. And when I say repositioning in the market, that means people that need to reload, for instance, their hedges, and that means there is a natural selling pressure. So not necessarily on the first day like we had this week, but a couple of days after the expiry, very often you can see and you will see moves in the market on the way down. This is exactly what we had. And I strongly advise you to look at what happened during the last expiry in June. And I think we had the top around the 10th or 11th of June. Then we had the start of the sell-off. And from the expiry, which was on the 19th, we had 1 week of selling. So that means that the market between the 10th and the 25th of June was pretty weakish, to say the least. And then I think it was from the Monday, 1 week after the expiry, the market started to bounce again. And it feels very much like, yes, on one hand, we can understand that there is fear of COVID again spiking and slowing the economies. And on the other hand, if you look at the price action of stocks like Tesla, Apple, Amazon, all those names, that there is a lot of options ongoing, positioning, and that has been affecting the market massively over the last 5 days at least. So check what's going to happen on Friday and Monday, because it feels like if we go back to the same scenario that June, those are very important levels that we are testing. So if we carry on with the asset class performances, this is something that I covered quite a long time ago, which was probably 3 months ago, when we look at the stay-at-home index versus the S&P 500. And you can see the stay-at-home index, which is made of companies that are benefiting from everyone staying at home, like Amazon, Roku, Peloton, all those names, you can see that this index have been outperforming the S&P massively. So the S&P is flat on the year, whereas this index is up 100%. But this index is getting closer to the all-time high. So the story of the COVID is still pretty strong. That is really something that is back into the market, and that we're going to be checking as well with the PMI. That is something that the market participants are looking again. I would like to go into the price action as always, and starting with the S&P. The idea is not to give you 50 trend lines. It's just to tell you that the 3200 is quite a level that where we had a bit of a fight before. Despite that, if you do the same chart on the monthly, if we stay around this level, that is really a bad candle that we have here. So we'll see. We still got a week to go before the end of the month, but clearly the price action has been really, really weak. If we look at Nasdaq Composite, this is a kind of the same story where actually those levels, the 10,500 to 1100 are very, very big level that we need to hold. If you look at the second derivative of this, which is the XLK, which stands for the ETF technology, doesn't look really, really strong. So we know that because of the ponderation and the weighting of those IT companies in the overall market, when there is weakening, that is affecting the overall market. If we carry on with the assets classes, I mean, this is something that we covered last week. We started to look at banks and banks, Citigroup, but not only Citigroup. If you look at the ETF sector, which is KBE, you can see that something that we mentioned last week and broke at the start of this week. We broke a very important level, and that can be said as well for the same story in Europe, where the Stock 600 bank is reaching very important levels. So this is a space to monitor. As I'll always say during the mentoring program, my conviction has always been, if the banking sector is weak, in the long run, even the mid run, it's hard for the market to be strong. So there is a huge dispersion here, where if you look at Citigroup, if you look at banks in Europe, if you look at KBE, there is really weakening in the sector. Emerging market have been doing fine. There is a bit of weakening, but so far they have been doing incredibly well versus the overall market. If we look at the US 10 years, that is not here, but the US 10 years is barely moving. Commodities, so if we look first at the WTI again is trading now around this 40 level. This is a level where we discussed that since June. This is a level where industrials, where big countries, producers are kind of not happy, but they can live with the WTI at 40. So as long as we don't have a peaking demand and so much supply coming to the market, especially Libya coming back into the market, 40 is the level, and it's going to be hard to do better. I'm not going to be doing the goal yet, because that's something that we're going to be covering at the end of this webinar. In terms of currency, that is something that we covered last week, looking at the euro dollar, and we look at the big picture. Let me give you a weekly, maybe you're going to see everything. Same here, very important level. There is a fight here. If it goes, it's not going to be overnight. And the dollar has been reversing after a 10% sell-off since the start of June, And that can be said across currencies, across pairs, sorry. So that's the same here with the Chinese yuan. If you look at the dollar yen, kind of the same story. And if you look at the DXY, you see these bonds that we have on a weekly basis. And that is really driving the whole market, and that had a huge impact across asset classes. So the dollar king, at least for the week, has been working. That is really the one that you should be looking at. If you look at the correlation against the gold, against the S&P, there is huge correlation in the market. So really look at this one these days, because this is what is important. Let's go back into the slides. If you have questions here, I'll be happy to answer those at the end of the call. The catalyst, as always, the catalyst. So there is not much ongoing at the start of next week. And if I say that, this is a bit misleading, because actually there is something that is quite important, because on Tuesday, we get the first debate between Biden and Trump. That's going to be interesting to see, on one hand, if Biden can hold a debate, because there have been a lot of rumors and talks that, probably he might be struggling. And as well, we're going to see what are the propositions that they'll be making. It feels as well that the market is a bit shaky because of these elections coming. And the polls after this first debate are gonna tell a bit about, the direction that we could have in the next month, depending on who is leading this debate. From the 1st of October, so from Thursday, we have the ISM manufacturing PMI, which is expecting it at 56. And then, as always, on the first Friday of the month, we get the NFP. Keeping in mind that the NFP is a lagging indicator, as you all know. But more importantly, we know that the weekly claims have been pretty poor recently. So there might be some, let's say, some disappointment coming, keeping in mind that the longer the jobs are lost, the harder it's going to be for them to be recovered. And that's a confirmation that we had over the last 6 weeks. If you look at today's price action at 1:30 UK time, when we had the weekly claims out and the numbers were not that great, the market sold off. The equity market sold off by 1%. So even if it's a lagging indicator, that is still, the weekly claims is less a lagging indicator, and that tells you a lot about what the market is looking at. So again, that is something that we discussed last week when we look at the discussion of the Fed and the Fed meeting. We know that at the end of July of this year, we had the end of this, $600 per week in the US help. And now the Fed, through Powell and some of the Fed speakers, is really calling for a fiscal stimulus, another boost. And at the moment, the market is kind of trying to define who's going to first to blink. Is it going to be the Fed, or is it going to be a fiscal stimulus? But something has to come, because it feels like if you look and read the reports on the US consumption, since the start of September, it has been weakening. And that means if we don't quickly give the US consumption a push, then there is a risk of a clear slowdown. Flash PMIs. So here we get the numbers of the flash PMIs. So we get the French one, the German one, Eurozone, UK, and the US. If you take most of them, It's a bit less true for the US, and this is why the dollar has been strengthening. But at least for Europe, what is very true is the services PMI have been extremely weak versus the forecast. So 47.5 for France. If you look at German, that is 49.1, and the Eurozone 47.6. So you have a story that is telling you that on one hand, the manufacturing in Europe is doing pretty well, but the services are pretty struggling, which makes sense because, you know, everyone needs to stay home. But that is really an issue here. I mean, on one hand, you can argue that the manufacturing is really leading in the long run for the cycle, the services, but the services are so much affected these days that there is a real problem. If you look at the US picture of the US, that is much better. So if you think about doing a relative trade, as always, when you do euro dollar, that has been one of the reasons that many market participants have been saying that the euro strengthening didn't make that much sense. So we're going to see if there's going to be a follow-up into these flash PMIs. But if you look at the flash PMIs here with the manufacturing again, you can see that the manufacturing are doing pretty well. Whereas based on, so here this is a chart from the Bianco research. So that's the spike in the COVID. So as COVID is spiking across the world, but more importantly, so the situation has been bad in the US for quite a long time. So I kind of feel like, you know, they are having, you know, 1,000 deaths every day, which is what it is. And in Europe now we get the cases spiking again, and many places in Europe they put again some lockdown. So if you read the flash PMIs that came out a couple of days ago, all the comments were on the fear of this COVID spiking again. I mean, we all know it, but clearly this is affecting activities. So for the French, we get the sharp rise in COVID-19 cases recorded across France during September helped to explain the first fall in business activity since May. If you look at Germany, the recovery in the tertiary sector has possibly reached a ceiling thanks to ongoing social restriction and still high levels of uncertainty in the economy. And versus that, so versus Europe, you get a picture that is not that bad with saying, you know, US businesses reported a solid end to the third quarter with demand growing at a steepening rate to fuel a further recovery of output and employment. So again, in terms of relative trade based on the flash PMI, you can clearly see that Europe is struggling and the momentum is going against Europe. PMI manufacturing Europe, again, this is the same story. So that was the picture for the flash PMI. Again, that is something that we have been discussing for the last 3 months. The struggling has been for those surveys when you come from a very low level and you ask people how they feel, there is a massive distortion. So if you have been doing your filtering and your ID generation only with ISM PMI, and then actually you have not been doing that much money and you have been probably struggling. And this is why, you know, my conviction has been as a mentor and as a portfolio manager and trader that you need to have ID generation not only based on macro, top down, but you need to have another ways of generating IDs. And this is why during the mentoring program and during the 4x4 video series, I explain different ways of generating IDs. So the flash PMIs, again, Europe struggling, US reaching a level not really moving up and down. So in terms of ID generation and special situation active trading, we're going to do something similar to what we covered last week when we discussed index rebalancing, and that was as well options expiry, sorry, with the quadruple reaching. Here I want to be looking at the end of the quarter, month rebalancing. So that is very true for the pension funds at the end of the month or the end of the quarter when they're going to rebalance their portfolio. So if you are a pension fund, you own stocks and bonds with different ratings depending on your mandates. If you look at the old mandate or portfolio, that was 60% stocks and 40% bonds, which is called at the 60-40. And at the end of the month or the quarter, what happens is if bonds outperform stocks here, so that will be stocks, at the end of the month, the bonds weighting in your portfolio will be larger than when they should be. So at the end of the month, what pension funds will be doing, they will experience an overweight of this positioning versus their mandate and benchmark. Hence, they will have to sell bonds and buy stocks to get back to their initial 60-40. And obviously, if that is the other way around, if stocks outperform, then you're going to be selling stocks. And because of the size of these pension funds, because we are talking billions and billions, those rebalancing cannot be done in the last 10 minutes of the quotation on the last day of the month or the quarter. So generally, they will be starting to do it over 3 to 5 sessions before the end of the quarter, and sometimes even before. So if you look at the strategy, this is doing a strategy on the reversion to the mean. So if the stocks have been outperforming, have been up, let's say 15% on the quarter, you know that the 60% weighting of the stocks for those pension funds have grown to 66, 67%. So mechanically, to respect their mandate and to follow their mandate, there will be 4 sellers of stocks, and that could put selling pressure into the equity market. And again, as I said, that might happen 3 to 5 days session before the end of the month. So let's look now at what we have on the quarter-to-quarter basis. So on the 30th of June 2020, the S&P 500 closed at 3,100. Whereas if you look at the bonds, I'm using here the Bloomberg Barclays US Treasury Total Return that actually you can be finding on Bloomberg, but even on Bloomberg for free. So since the end of June, and if we look at 2 days ago, which is not very different from what we had today, the S&P is up 4.4%, whereas bonds are small up, but let's say flattish. So normally in a situation like this, and this is what has been happening as well since the start of this week, is because the equity market quarter on quarter has been pretty up, you have a natural flow of sellers of those mutual funds coming into the market. So if we take the example, normally the 5 sessions into the quarter end will be from tomorrow. Again, because now we are only at 4.54% quarter to date, that is not massive, but that is something that I strongly advise you to be building in terms of strategy and checking every month, more importantly, every quarter. That is a strategy that has been working pretty well on a quarter, where, again, if stocks have been performing well, you have a tendency of a small reversion to the mean. Always hard to define by how much, but this is a pair trade that you can be doing. So if we look at the chart here, that is for the S&P. So that is the chart as of yesterday. You can be probably adding the candle of today, which is something like probably like this, where the S&P at the end of June closed around 3,100, has been up massively. So you have pension funds that need to be selling and have been selling and might be selling a bit more, but you know that the selling pressure is not going to be as big as before because of the change that is now only at 4%. So, and now if you look at the stems chart, but for the Bloomberg Barclays US Treasury total return, HUNH, US dollar, you can see, so that is 2,576. You can see that is roughly flat since the end of the quarter. So, and that's something as well that we mentioned at the start of the call, which is if you look at the US 10 years, the US 10 years has been not doing much. So bonds have been pretty dull. I mean, treasuries, should I say, have been pretty dull over the last, since June. So nothing is happening. And really the activity, let's say most of the business has been down and happening stocks, stocks, commodities, and FX. So end of the quarter. So now I would like to look a bit at gold and silver. Why? Because gold has been down 4% on the week. Silver has been down 8 to 10%. But more importantly, why is, if you've been watching me for more than 1 month, you know that I've never been a big fan of gold. I've been wrong, and I don't play against the gold. Let's put it that way. But I know that for many retail traders, it is sometimes, and most of the time, you know, position that is easy to sell. Meaning that if you call for the end of the world, many retail traders will go for the gold or the silver. My view is always, you know, there are many opportunities, but the downside with trading gold and silver, very often market participants and retail traders, more importantly, are taking huge position. Okay, so on the basis that that is a safe haven, no, that could be seen as a safe haven, there is no or very poor risk management when people are trading the gold. And what you had this week is probably an unwinding and margin calls for many retail traders. But I want to understand with you a bit more about what is driving the gold. So as we're going to be looking, there is an inverse relation between the gold and the dollar. We're going to be looking at gold versus real interest rates. Again, the concept of safe haven for the gold, and as well the expiry. So coming with the last point, which is the expiry, there were some options and some contracts maturing this week. Like for stocks last week and this week, the market is more and more driven for any asset classes by options. So when you're trading an asset, please make sure that you understand a bit about the futures and you understand when the futures and the options are maturing, because you can be sure that at those specific time, you're going to have big moves in the underlyings. This week, there has been a lot of unwinding. There is nothing natural when the silver is just dropping 10% when gold is dropping 5% very quickly. So this is people suffering somewhere. So I think what has been confusing for many market participants is what the Fed is trying to tell us. So that's something that we discussed since last August, at the end of August, when we look at the Jackson Hole and Powell changing the two components of the Fed mandate, which are inflation and unemployment. And really the struggle is on their mandate on the inflation. So if you remember, before we had the target of 2% inflation, whereas now we get averaging 2%. So to give you an example, on Tuesday, there was some hawkish comments from the Chicago Fed President Charles Evans, who is a non-voter at the Fed, but will become a voter in 2021, where was saying we could start raising rates before we start averaging 2%. So on the back of it, what happened is the dollar strengthening. And as the dollar was strengthening, guess what? Gold, silver, selling off. Then yesterday, on Wednesday, I don't know, maybe because he had a call from Powell, then he said, we need to be above 2% inflation for some time. So this is a very, very confusing message from the Fed. I don't think that they have a clear understanding of what they want to be doing, but that has huge implication for the gold and the silver. So if we look at the chart of the gold, again, we discussed that before when we look at gold around 1800, long time ago, and we look at this massive base and consolidation that we had for years and years. And when it broke the 1800, it just went through the roof. So in a sense, that trade was, at least as a trader, was an easy one. Then we had the spike, consolidation, and since then, it seems that, you know, breaking the 1900 technically is not very appealing, to say the least. If you look at the 200 moving average that we can see here, it's at, I think, 1750, so 5 to 10% below. So if you think about reversion to the mean, there is a downside. I think this week what has been showing is there were too many people involved in that trade. And at the end of the day, when you look at the gold, when you look at the silver, you need to be looking at real interest rates. So here we have the chart in blue of the gold, and in orange we get the 10-year Treasury inflation adjusted. And you can see there is a massive correlation. So what has been happening over the last week or so, last 10 days, is there has been a small pickup in inflation coming down a bit, expectations, which we're going to be looking afterwards. But as inflation expectations are coming a bit down, one of the idea of the gold is this is safe haven, and because the Fed is going to be creating massive inflation in the system, I need to cover with gold. The reality is the story has been changing a bit over the last 2 to 3 weeks, and hence the sell-off in gold and silver. Here we have the chart of the 5-year forward inflation. So when you're a trader, you're always looking at people that are mentioning this 5-year forward inflation, which is kind of silly if you think about it, to try to guess where inflation or where something is going to be in 5 years' time for 5 years. My conviction, and we are in a world where it's even hard to have, you know, most of the time visibility for more than 6 to 12 months. If you ask many CEOs, they will tell you we get a vision, but they need to adjust every 3 to 6 months. So looking at inflation here, which is the 5-year, you can see that inflation has been coming down a bit. Here I'm talking short term. It was way below the 1% when the whole market collapsed. But the 2%, which is the target, still is not going to be reached before quite some time. And that's the same if you look at the PCE, at the personal consumption expenditure, which is really the target of the Fed. We are not going to reach it immediately. That is something, again, that we covered with the euro-dollar futures. There is not much inflation in the system. There is a bit of inflation and CPI. That's going to be interesting to look at it in the next 3 months. But not as much for real interest rates to be jumping very high. So that means this is why we had the gold and the silver selling off. As well, here we get the chart of the gold versus the DXY, which is for the dollar index, DXY on the left-hand side, and the gold reverse. So again, when the dollar is weakening, the gold is strengthening and vice versa. And you can see that since the start of the year, there has been a massive correlation. And the dollar weakening over the last 2 weeks or 10 days has been creating some pressure on the gold. So that was something that I wanted to cover. I know from my experience as a mentor that each time, very often when one of my mentees has an exposure in gold and silver, it is a kind of, he forgets to do the risk management. So suddenly, instead of having 10% exposure like stocks, he will have 50, 70% or something like this. And his exposure will be abnormal. And most of the time, this position is going to be a long-term position because you go long the dollar saying, you know, this is a safe haven. This is to protect my overall portfolio. So it feels like you have a big position without any clear stop loss. So guess what? Big position, no stop loss. Those are the two things when you do that with your portfolio management, you know it's going to end in tears. So by definition, when you put a position is always a conviction, that you always have a conviction somewhere. So if you have a conviction, you need, I mean, again, I've been saying that over and over, you need to be careful on your stop loss and the size of it. And I know, and we all know, if you are listening to this webinar, you all know that so many retail traders are losing money trading gold. Why? Because they trade gold as they will be trading FX. Huge position, huge leverage, closing your eyes, this is a long-term position, this is different from the rest of the book. And in reality, it's not different from the rest of the book. It's just that you're going to be, and you might be losing money. There is a question here about, would you prefer trading gold or gold mining stocks? Again, as I said, I'm not a big fan of trading gold too often or gold miners. I trade gold. So this year I traded gold when it broke the 1800. So that was the trade that I've done. I traded silver when it was at 1450 something. So I trade the gold like I trade many currencies once every 3, 6, 9, 12 months. Is if there is a good risk reward. I'm not actively trading. If I look at the gold mining stocks, I think it requires a lot of research because you have many risks attached to that, which is very often, if you look at the gold miners, they have exposure to emerging kind of funny countries where you have a risk. You need to be looking at what is the management, where are the mines, what is the cost. So you get the whole supply chain. It's a lot of work. So obviously there is more upside, but you need to be looking at the balance sheet as well. So when I do the gold miners, very often when I do trade, it's more sometimes on an arbitrage when I could be trading ADR, or sometimes I could be trading on a pair trade, one versus the other. But the more liquid those things are, the more like that's my conviction. And if that's something that I try to push hard during the mentoring is you always need to start from the top. Okay, so you start from the top, which is the gold, and you go down into the gold miners. If your conviction is on the direction of the gold, but you are struggling in doing the analysis of the companies, at one stage you have to admit that the job is not good enough. That doesn't mean that you cannot be putting the position. And that is why I strongly advise you, And that's something that I say over and over when I do the mentoring. Don't force the trade, okay? Never force the trade, because if your idea is to trade the gold and you end up with being long one miner versus another, and you haven't done the job, there is 80% chance that the trade is going to be a disaster. Okay, so yes, sometimes we want to be trading the gold miners, but the gold miners, you need to go to the balance sheet, you need to go to the management, you need to go to the mines, to the reserves, to the hedging policy. So that's a lot of work, and still with that, you're gonna have many more risks. So whereas when we trade the gold, I have levels, I have conviction. And finally, something that I want to discuss as well, and which is the gold positioning. So here looking at the cftc positioning. So that is for the gold. As you can see at the start, so from the end of last year, or let's say June 2019, we had a massive positioning of retail traders. So when you have an extreme positioning on one asset, very often it's easy to shake these weak hands. And this is what we had recently. We know that since March of this year, because of the sell-off, because of flight to heaven, gold has been doing well for retail traders. But we know as well that very often retail traders might be late in those trades. So one mistake that you should not be doing is stop loss and too much concentration in that position. The rest, look at the correlation between the gold and the dollar, and the correlation between, more importantly, with versus real interest rates. The correlation between the gold and real interest rates has been massive, and you can do that over 10 years. And that is, if you look at what happened over the last 5 days, this is exactly what has been happening.